Corporate Finance OneNote Practice Problem. In this presentation, we're going to work a practice problem in OneNote related to book value per share. Get ready, because it's time to take a stance with corporate finance. Here we are in OneNote. If you would like to follow along in OneNote, you're not required to do so, but if you have access to it and would like to, we are in section 233, book value per share, under the practice problem tab. Closing this back up, we're going to have our information up top, and then we'll do our calculation with that information down below. We're going to be looking at the book value per share calculation. We got our data to do so, which is going to include our current assets, fixed assets, current liabilities, long-term liabilities, preferred stock outstanding, shares of common stock. We are, in essence, going to use this information to create basically an accounting equation. When we're thinking about our accounting equation, we're looking to get to equity here, because equity is going to be the book value of the company. So we're thinking about the book value per share. When you're thinking of the book value per share, you're looking at the books, which is another name for basically the financial statements that we have. The major statement that shows where we are at this point in time is the balance sheet. That shows where we stand at a particular point in time. The balance sheet is typically given in terms of a double entry accounting equation. For accountants, will always be assets equal liabilities plus equity. Assets representing what the company owns, liabilities and equity representing who has claims to those assets, therefore these being two sides to the same coin. What the company has, who has claim to those assets, either third-party folk, third-party people, liabilities, or the owner, which is represented by equity. From a finance standpoint, we'll often be changing this accounting equation algebraically, by subtracting the liabilities from each side to assets minus liabilities equals the equity. And this is useful from a finance perspective because that means that the assets minus the liabilities equals the equity, and the equity represents what is owed to the owner. So the book value then of this company would be the equity section, because the equity section represents what the company has, minus the value of what they have, minus on a book value basis, minus what they owe to third-party people, liabilities. That means what is the value to the equity, the owners. Now, when we think about the owners then, now we've got, okay, this is kind of like the book value for the owners. Now, if it was like a sole proprietorship and you only had one owner, that would be it. This would be like the value to that one owner. But then if you had like a partnership, you'd have to break out that equity between the partners, and that gets confusing because partnerships can have different kind of profit sharing ratios and whatnot. You got a lot of different things you could do with a partnership, which is really nice, but it confuses the equity section a bit. The corporation is really nice because we simplify the equity section. Even though you might have a lot of owners in the company, we allocate the ownership to those owners through standard chunks of the company, which are stocks, kind of like giving out dollars representing standard units of value. So all the stocks are going to be basically the same, and therefore we can break out the equity per stock, right? And that's going to give us kind of like our book value per share. So remember, when we think about the book value per share, it doesn't necessarily mean, obviously, that that's going to be the market value per share. This is just another calculation that we can use, and we'll discuss a little bit more about that later, but this is the book value. So let's take a look at our numbers. We're going to say this is basically kind of a balance sheet calculation. They gave us current assets. They gave us fixed assets. So I'm going to put them in a little worksheet like this. I recommend doing these problems in Excel too. We do these in Excel so you can practice putting this information into the formulas, but if you want to just look it over here or do it pen and paper, you can do it this way as well. We got the current assets, fixed assets. We got the colon. I'm indenting it for the formatting of the worksheet, and then we're going to add up the total assets on the right-hand side. Total assets 403. Then we got the liabilities. They gave us current liabilities, and they gave us the long-term liabilities. We're assuming those are the only liabilities involved. Therefore, total assets is going to be the 403. Total liabilities added into the outer column being the 219. If we then subtract out the liabilities and then the equity, we're going to get the 403 minus the 219 without the zeros is the 184. So there's going to be the 184. That would then be the equity. Now, if you want to double check this and verify basically in a balance sheet type of format, then of course you can add up the liabilities and equity, the 219 plus the 184 has got to equal the 403, because obviously we got to the to the 184 by subtracting the 403 assets minus the liabilities here. So we're focusing in on the equity, which represents the book value of the company. Focusing in on equity. Then we go down to the book value per share calculation. We're going to have the equity, which is going to be the 184. So we're bringing that 184 on down. We're going to take the preferred stock outstanding out, which is going to be the 40,000. The preferred stock kind of always muddies the water. Preferred stock will not always be there. But remember that preferred stock, the thing that's preferred about them is they typically get paid first. Therefore, even though they don't have voting rights, therefore we got to remove the preferred stock before we can allocate the equity to the common stockholders. So the common stockholders aren't preferred in payment, but are preferred in terms of their value and their voting power and whatnot. So then we got the difference is going to be the 184 minus the 40,000. That's going to give us the net worth, the net value that we can assign to the common stockholders, who we think of as basically the owners of the company. Then we can divide by the number of shares or stock outstanding, remembering that that doesn't mean there's 25,000 shareholders, 25,000 shares, of which one holder can hold many. Those shares kind of like dollars that show equal kind of percentage portion allocation of ownership equity amount to owners. So then we can divide that out, and we're going to then get the book value of 5.76. Now, of course, this is an estimate because it's the book value, so there could be rounding as well. 144,000 divided by 25,000 it actually goes exactly into 5.76, but you could quite possibly have, of course, rounding with a calculation such as this. You want to keep that into consideration when working these kind of problems, or in practice, of course, as well.